In this video, we want to talk about how we can utilize this information about stocks, about investing in assets and their risk levels. How does that affect our decision making? There is a theory that's referred to as the capital asset pricing model. Again, it's a little bit complex. It's a little bit beyond this particular course and video, but essentially what it says is there is a formula. It's this formula right here called the security market line formula. And it states that a stock's required return is equal to the risk-free rate plus a risk premium. Now, what is the risk premium? It has two parts to it. R sub M minus R sub F. This is what we refer to as the market premium. Now, when you take the market premium and multiply it by what we refer to as beta, and we'll talk more about this in this video, this is what we refer to as the risk premium of the asset. So the primary conclusion here is that the riskiness of a stock is its contribution to the riskiness of a well-diversified portfolio. How do we know that? Because beta is a measure of market risk, and market risk is the risk that we're interested in if we're making portfolio decisions. So again, what's the most important measure of risk as we go through this? Individual assets, standard deviation. For portfolios, the correct measure of risk is beta. Beta is a relative measure of non-diversifiable risk or market risk. It measures the degree of change in an asset's returns when the stock market changes. So the historical returns are used to help find this asset's beta. The beta coefficient of the entire market, or said another way, the stock market's beta is 1.0. All other betas then are viewed in relation to how it stacks up against the stock market beta. So again, the market return then is the return on the market portfolio of all traded securities. So let's dig a little deeper. Again, beta measures a stock's market risk. It shows volatility relative to the market. So it indicates how risky a stock is if the stock is held in a well-diversified portfolio. The bigger the number, the greater the market risk, and the more risk will be added to a portfolio if you invest in it. So kind of review what we've just talked about. If the beta equals 0, we say it is just as risky as the average stock, or it has the same risk as the stock market. If beta is greater than 1, it's riskier than average. Less than 1 means it's less risky than average. Most stocks have betas between 0.5 and 1.5. Now, there are some extremely low betas and extremely high betas. Let's just talk about an average. Where do those numbers seem to fall? So let's kind of think about this, how we relate this in general. So let's say we have a company has a beta equal to 2.0. The market has a beta equal to 1.0. So this company, we would say that it is twice as risky as the stock market. What if its beta equaled 0.75? What this tells us is this company has 75% of the risk of the average risk in an asset in the stock market. Before we go and do any other kinds of calculations, how do you think that affects returns? Remember, we have this risk return trade-off. As risk goes up, you expect returns to go up. So a high risk asset should earn a greater rate of return than the stock market. How much? We need to do a calculation to figure out how much more. If an asset has less risk than the stock market, we would expect it to make less than the stock market. So in this case, we would expect some rate of return that's less than whatever the stock market earns. So could the beta actually be negative? It could if it had a negative correlation with the stock market. That is very rare, right? So you can't typically find assets, stocks, that are negatively related to the stock market in general. From time to time, they may be a little better, and it could be negative, but rarely for very long will that maintain. How do we calculate betas? Quite frankly, you don't really need to know how to calculate beta. We just need to know where to find beta. So where do you find beta? You can find beta in many published websites. Yahoo Finance, Zacks, Morningstar, Kiplinger, Bloomberg. All of these websites, if you identify a company in that website, it will tell you what its beta is. But let's think about how calculation happens, because it's kind of interesting to know what's going on here. So well-diversified portfolios, again, are concerned with seeing how a stock relates to the stock market in general. Right? So we want to estimate beta, and we do that by using a statistic called regression, or the sum of least squares calculation. So what we have here is we have a line. In this case, there are only 3 data points. 1, 2, 3 data points. We want to try to explain these. Now, assume that this is the stock market on the x-axis, and this is the stock on the y-axis, right? So for this company, again, if you look here, the stock earned 15%, it was negative 5%. That's, the stock market was at negative 10, and the stock was at negative 5. So you have negative 5, 10. That's this point right here. So we look at this, how the slope of this line, when you do this statistic, is the measurement of the overall beta of the company. So if we look at our statistics from before, and we look at their expected returns, we also then know what the betas are of these companies if we do this statistic. So what we can find out, high tech has the highest expected return. It has a beta of 1.31. The stock market, again, 8%, has a beta of 1. T-bills, expected return 3. It has a beta of 0. Collections earns 1.2%, but it actually has a negative beta. So it appears riskier securities have higher returns. So this rank order seems to be okay. But we want to calculate what do you want to receive. The security market line reviews or looks at your required return. I want to get my pen turned on here. It doesn't seem to be working. It measures your required returns, right? So here's our formula. It's the risk-free rate plus the risk premium times beta. So in our formula, they're assuming a flat yield curve. Risk-free rate's 3%. So the risk premium, if the stock market makes 8%, the risk-free rate's 3%, the risk premium is 5%. So we have a formula that says, look, 3%, the risk-free rate, plus 5 times beta, that measures the rate of return that you require from this investment. So what is this market risk premium? Let's talk about a little bit more detail. It's the additional return over the risk-free rate to compensate you for the average amount of risk. Now, when we multiply this by beta, it identifies the specific risk of this specific asset, and that measures the risk premium for the entire asset. So again, where this risk premium lies, it varies obviously from time to time. Most of the time, it's ranging between 4 and 8%. So let's look at our calculations for our assets. Here's the high tech, right? 3% plus 5 times 1.3. The required return on the high tech stocks, 9.5. Market is 8. The rubber is 7.4. T-bills 3. Collectibles 0.5. So the security market line tells us theoretically what rate of return do you want to receive. So now let's see how we use this information. The high tech company earned the high-tech company earned 9.9%. We only wanted 9.55%. Would you rather get 9.9 or 9.5? Hopefully you answered 9.9. Well, if you'd rather buy this, it must mean that the price is too low. So this risk-return trade-off that we've been talking about implies that if risk goes up, required returns go up. To get a higher return, the price that you purchased it at has to be a lower price. So the stock market earned 8, you require 8, it's fairly valued. U.S. rubber, 7.3% is what it received, but you wanted 7.4. This would be, the rubber would be a bad investment because it identifies something where you want a certain return, but it's not going to give you that return. So let's look at collections though. 1.2% is what it earned. Technically, according to theory, you only want 0.5%. So it actually pays you more money than you want in a risk-adjusted basis. So if you have the security market line, it tells us that the things above this line, high tech and collections, are above the line. These are good investments. They are what we would say are assets that are undervalued. Their price is lower than what you would expect it to be. Things below the line imply things that have high prices. How do you do this with a portfolio? Again, you can apply the weights in a portfolio in a spreadsheet. The formula is the weights times beta, right? So if you look high tech and collectibles together, 50% times 1.3 is the beta for is the weights weighted beta for high tech. A half of negative 0.5 is that's the beta then for the collectibles. So the beta of this portfolio is 0.405. If we put these three assets, and I only included these three assets, right? So we have 60% of our money is invested in A, 15% in B, 25% in C. We then end up, here's our weights, or our returns, and here are our portfolios, or our betas, I'm sorry. So this portfolio earned roughly 7.95%. This portfolio has a beta of 0.93. If you plug that into our formula, a security market formula, this portfolio of 60%, 15%, 25% should have earned 7.6%. It actually earned 7.95%. So this portfolio earned a higher rate of return than it should have theoretically. So let's talk a little bit more now about some things that can change, right? We know the world doesn't stand still. Some things change. What happens in an inflationary time? The security market line shifts, but it shifts parallel. So if inflation goes up by 3%, the entire security market line goes up by 3%. So what used to earn 8% should now earn 11%. If we apply this to our current investment inflation environment, with inflation at 9%, everything should be earning a 9% higher rate of return than it did last year. Now, when you have these extremely high inflation changes, it just doesn't happen, right? Almost all the assets are going to fall below this security market line because inflation is beating up on our investments. Now, in economic times that are difficult, investors become more sensitive to risk. Their risk aversion increases. So what happens in this instance is that the security market line pivots, if you will. It stays at the risk-free point down here, but it's going to change in this upward direction if we as an investing public get more risky. What that does is it takes some of these good investments now become bad investments. Not all of them. It doesn't shift parallel. So some of these investments down here will remain good, but these investments up here, the much riskier ones, ultimately may turn out to be bad investments if, as an investing public, we don't understand or don't appreciate the changes in risk. So what do we know about capital asset pricing model? It hasn't been completely verified. It has some issues. There are some problems that make this overall verification difficult. Some argue that there are additional factors other than just market risk. And that's the contention now, is that there are, especially when you think about investing in stocks, there are other variables that should be added to the formula. So again, that's the end of our risk video. I look forward to seeing you next time.